Have you ever wondered how a central bank's decision to change interest rates can rippling through an entire economy? It sounds like magic, but it's actually a simple mechanism at work. And by the end of this video, I'll explain exactly how that happens. Imagine interest rates are like the volume knob on a giant radio. When the central bank turns it up, it makes borrowing more expensive and saving more attractive. Conversely, when they turn it down, borrowing becomes cheaper and spending gets encouraged. And here's the surprising part. This simple adjustment can have a huge impact because it influences nearly every aspect of our economy. Here's how it works. When interest rates go up, loans become more costly. This means businesses might find it harder to take out loans for expansion or investment projects. They might also delay big purchases like new equipment or hiring additional staff. On the flip side, higher rates make saving and holding on to cash more appealing. And here's another twist. When interest rates are low, borrowing becomes cheaper. Companies can more easily finance their operations and growth. Consumers spend more because loans to buy houses, cars, or even go on holidays become less expensive. This increased spending can lead to a boost in demand for goods and services, which can drive up prices. Now let's drill down into why this matters so much. Interest rates affect everything from inflation to employment. When the central bank raises rates, it's often trying to cool down an overheating economy where prices are rising too fast. Lower rates might be used to encourage growth when the economy is slowing down and unemployment is high. But here's a myth buster. Interest rates don't just control borrowing. They also influence the value of your savings. When rates rise, the return on your savings account or bonds goes up, making saving more attractive. But if you have variable rate debt, like a credit card balance, those costs go up too. So, next time you hear about central banks tweaking interest rates, remember, it's not magic, it's just adjusting that giant volume knob to keep the whole economy in tune. Imagine you're at the helm of a huge cruise ship, navigating through an expansive ocean. This is similar to how we can think about central banks, like the Federal Reserve, as the captain of our economy's vast seas. Here's how it works. When the Fed decides to move interest rates, they're essentially adjusting the rudder of this enormous ship. If they lower interest rates, it's like turning the rudder to the right, allowing the ship to sail faster and more smoothly through the waters, encouraging more spending, borrowing, and economic growth. And here's the surprising part. When they raise interest rates, it's like turning the rudder to the left, slowing down the ship and making it a bit harder for everyone. This is done to cool down an overheated economy or to prevent inflation from getting too high. Now, let's break this down further using our cruise ship analogy. When the Fed lowers interest rates, borrowing becomes cheaper. It's like giving passengers free passes onto the ship, encouraging them to spend more and sail into various ports of call. This extra activity can lead to more jobs being created as businesses expand their operations. Conversely, when the Fed raises interest rates, it gets a bit trickier for everyone on board. Higher interest rates mean loans cost more, like having to pay extra for your tickets. This might make passengers think twice before spending or borrowing money, and instead save some cash in their wallets. As a result, businesses may find themselves with less demand, leading them to slow down hiring or even lay off workers. So, let's dive into how interest rates affect borrowing power. When central banks raise interest rates, it's like they're putting a higher price tag on loans. Think of it this way. If the price for gas at the pump suddenly went up by $1 per gallon, would you still fill your tank as often? Probably not. And here's the surprising part. When borrowing becomes more expensive due to higher interest rates, fewer businesses and consumers can afford to take out big loans for projects or purchases. Let's break that down a bit further. Imagine you're starting a small bakery. You need $50,000 to buy new ovens and hire more staff. At low interest rates, this might be relatively easy to secure from a bank. However, if interest rates go up significantly, suddenly your loan for that same amount will cost much more over time. The monthly payments will be higher, making it harder for you to manage your cash flow. Similarly, when individuals want to buy a house or big appliances, they might decide to wait and save instead of taking out a larger mortgage with higher interest payments. This means fewer large purchases and less spending overall in the economy. The impact is not just on small businesses like bakeries. It ripples through the entire economy. Fewer large projects, reduce consumer spending. These actions can slow down economic growth because there's less money circulating for big-ticket items. And now, let's dive into another surprising part of how interest rates affect the economy, how they influence people's spending habits. Most people think about higher interest rates as just a cost for borrowing money. But there's another powerful effect lurking behind that. It makes us save more and spend less. Here's an analogy to help you understand. Imagine you have a piggy bank, and every time the market whispers rates are going up, it's like the piggy bank suddenly starts earning interest. People start feeling richer because their savings are doing better, even if they haven't put in any more money. This newfound wealth makes them less likely to spend all their cash on things right away. So how does this impact the economy? Well, remember from our previous scenes that when people borrow and spend, it drives up demand and can push prices higher, inflation. But now, with higher interest rates making saving feel more attractive, people are actually putting more money in the piggy bank. Less spending means less demand for goods and services, which can slow down how quickly prices rise. And here's the surprising part. This is why central banks often raise interest rates during inflationary times, because they want to cool things off a bit by making saving more attractive compared to spending. It's like turning down the heat on a stove. You're not putting out the fire, but you're reducing how much fuel gets added. All right, so we've been talking about how higher interest rates make it harder for us to spend. But now let's flip it around. What happens when interest rates go down? Well, suddenly borrowing becomes a lot cheaper. Imagine you're at a grocery store with a bunch of money in your wallet. If interest rates are high, it's like prices at the store are super inflated. You can't buy as much because every dollar is going to cost more. But what if those prices dropped instead? All of a sudden, each dollar goes further, and you can buy more stuff. And that's exactly how it works in the economy when interest rates go down. When borrowing becomes cheaper, more people can afford to take out loans for things like buying homes or cars. And guess what? Companies start to borrow more too, to invest in expanding their businesses. Let's get a bit more concrete with an example. Say you're running a small business and want to buy new equipment to make your products faster and cheaper. When interest rates are low, the cost of that loan is lower too. So instead of being worried about the price tag, you can go ahead and invest, creating jobs and maybe even offering better services to customers. Here's the surprising part. When more people and businesses borrow money at a lower rate, it pumps up spending in the economy. More spending means more activity, which leads to growth. It's like turning on a faucet that was previously closed. Now water starts flowing, and everything gets a little wetter, a little greener. So there you have it. Lower interest rates make borrowing cheaper, encouraging spending and investment, which can boost the entire economy. It's like the opposite of what we saw before, where high interest rates made us want to save more. And here's the surprising part. When interest rates go down, it's like dropping a stone into a pond. That little splash starts small, but soon spreads across the entire surface. So how exactly does that work? First, let's talk about personal finance. When people see lower interest rates, they feel more confident about borrowing money for big purchases like houses or cars. It's almost as if the bank is saying, sure, go ahead and buy that car you've been eyeing. This increase in borrowing leads to higher spending, which is fantastic news for businesses that are suddenly getting more orders. Next, companies see a boost too. With lower interest rates, they can borrow money at cheaper rates to invest in new projects or expand their operations. It's like the company has more fuel in its tank, allowing it to drive faster and further. This additional investment often leads to hiring more workers, driving down unemployment rates. But that's not all. The economic ripple effect doesn't stop there. When businesses are doing well and people have extra money in their pockets from lower borrowing costs, they start spending more on goods and services. This increased demand can lead companies to raise prices. Hello, inflation. But also means more jobs are created as the economy grows. It's like a series of concentric circles expanding outward. Lower interest rates nudge banks to lend more, which encourages people and businesses to spend and invest. That spending and investment then create a chain reaction that ripples through the entire economy. Job creation, economic growth, and sometimes even a bit of inflation. So you see, lowering interest rates is like turning up the volume on the economy's engine. It starts small, but can have a huge impact, just like those waves in the pond eventually reach every corner.